What if I told you there was an investment that was comparable to the stock market, but with virtually no risk and no volatility? You'd think it was too good to be true, right? Well, it does exist, and now is the time to consider them. I am talking about I-bonds, people. Now, there are many advantages to I-bonds, especially in this current market, but there are also some drawbacks as well. That's what this video is all about. We're going to talk the pros and the cons of I-bonds. Hey everyone, this is Andy Hill from Marriage, Kids, and Money, a channel dedicated to helping you strengthen your family tree and live financially free. If you're new to the channel and you like what you hear today, please consider giving me the YouTube triple thanks. That's hitting the like button, subscribing to the channel, and then commenting something nice down below. Thank you very much. I appreciate it. Okay, what are I-bonds, right? Well, you've heard all about them, right? There's a good chance you know what a savings bond is. Perhaps you remember getting one of those paper EE bonds as a young kid from an older relative. Or maybe you remember the moment your family finally turned those over to you, right? Well, I-bonds are another type of savings bond, though they're not typically issued on paper anymore. Like the other bonds you may be familiar with, I-bonds are backed by the U.S. Treasury. I-bonds pay interest in two ways. One is a fixed rate that the U.S. Treasury sets, and the second is an inflation-adjusted rate that is based on the Consumer Price Index, which is called the CPI. They've increased in popularity a lot lately. In fact, in April 2022, over $4 billion in I-bonds were issued. So why are I-bonds so popular right now? Well, many people view them as another way to protect your money from losing its buying power due to the sky-high inflation we're currently experiencing. That's where the CPI comes in. And as the CPI rises, so do I-bonds. Now that you have a better understanding of what an I-bond is, let's explore those pros and cons of I-bonds to see if these savings bonds are right for you. Pro number one, lower risk. One of the biggest advantages to I-bonds is how little risk they pose to investors. We often think of investments that yield high returns as ones that also involve greater risk. That is oftentimes very, very true, especially when it comes to the stock market. Yet, I-bonds pose very little risk to the amount you invest. I-bonds are backed by the U.S. government. That means that the government would have to fail for your principal to be at risk. As far as investment options go, I-bonds are virtually risk-free. Number two, returns can help combat inflation. People are right to worry about inflation. It can eat away at your money's buying power even when inflation isn't sky high. Because I-bonds are tied to the CPI, that means that they can often help you earn enough to keep pacing with inflation. The fact that the stock market is in a current slump makes I-bonds particularly appealing. Over the course of a long-term investor's lifetime, the stock market should easily outpace inflation. But in periods of drops, many investors look for other ways to battle inflation. Number three, tax perk for education. Another benefit to I-bonds is that you can use them to pay for higher education. While we typically think of 529 plans or UTMAs as a means to help our kids pay for college, I-bonds are also an option. If you use I-bonds to pay for tuition, Treasury Direct says you can exclude some or all of the interest earnings on the bond from your gross income. This can be especially useful to people who don't get any tax benefits for 529 plans. Now let's review the disadvantages of I-bonds. Con number one, the future is unknown. Every investor has likely heard that you can't predict what the market will do next. I-bonds are no different. When the rate of I-bonds previously passed 7%, people thought the rate would be as good as it gets, right? Then the U.S. Treasury announced rates would go even higher to nearly 10%. When you purchase I-bonds, you lock into a set rate. So if rates go higher, you won't get that bump. While it's possible that these rates will go up, they might also go down. Timing the market isn't possible as much as we might wish it were. If you understand the I-bond pros and cons, and you think that they fit in with your other financial goals, you likely won't be worrying too much about this particular drawback. Number two, I-bonds maturity time. I-bonds are designed to be long-term investments that mature over the course of 30 years. You can cash out your I-bonds early though. You have to hold on to them for at least 1 year. That's the caveat, 1 year. If you want to dodge a penalty though, you need to keep them in for 5 years. Otherwise, you forfeit the last 3 months of interest, which isn't too bad, but it's a long-term investment. If you're looking to purchase I-bonds, you want to be mindful of the fact that your money isn't very liquid. That means that it's harder to access. And that's no problem for the long-term investor if that's you. But if you're wanting to put your emergency fund into I-bonds, we would not recommend this. Number 3, limits on I-bond amounts. I know what you're thinking, everybody. If the rate of return of I-bonds is guaranteed at 9.6% right now, I'll just move all of my money over there, right? Well, not so fast. There are limits on how much each individual can purchase every year. The I-bond limits are currently $10,000 per person for electronic bonds, and then $5,000 with your tax return for paper bonds. There are also regulations around gifting and other details you're going to want to review on their website, treasurydirect.gov. That doesn't mean you shouldn't purchase I-bonds. It simply means that I-bonds can't suddenly become your entire investing strategy. Number 4, I-bonds purchasing platform. Another disadvantage of I-bonds has to do with how you buy them. The platform you use to buy I-bonds leaves a lot to be desired in terms of its interface. Not much of a user experience there. Some users claim it's difficult to navigate. Others report that getting in touch with an actual person for live support is time-consuming. But since the Treasury is churning out billions of dollars of I-bonds each month, we can maybe cut them a little bit of slack here. While it's true that Treasury Direct feels dated and clunky, what it lacks in user experience, it may more than make up for in its guaranteed high return rate. Number 5, I-bonds paperwork. Are you spoiled with a finance platform that makes it easy to grab at a glance summaries of your transaction history or send you notifications about your money situation? I know I am. Well, you and I could be in a rude awakening with I-bonds. As an I-bonds investor, you have to keep track of your own paperwork. You want to keep a record of what you purchase and when you purchase it. If you end up purchasing more than the $10,000 annual limit, Treasury Direct will issue you a refund. Now let's talk about how to buy those I-bonds if you're interested. Well, you need to head over to the U.S. Treasury's website at treasurydirect.gov. Then you can follow these steps to buy I-bonds. First one, create an account by clicking Open an Account. Then check your email for your account information. Then log in with your account number and a passcode that will be emailed to you. Choose the Buy Direct option and select Series I. Indicate the amount you want to purchase. Note that there's a minimum of $25 here. Then enter your bank account number that the money will come from. Decide if you want to set up recurring transactions. Then review and complete your purchase. You can revisit Treasury Direct to purchase more bonds or to review your current balances. You also want to note that you can't buy I-bonds with the money you keep in your IRA, Roth IRA, or any other retirement account. Instead, you have to purchase I-bonds with separate money. If you're someone who gets a tax refund, you might be pleased to know that you can use your tax refund to purchase up to $5,000 in paper I-bonds. In the end, I-bonds are an exciting concept right now. Many people see them as a way to battle record-setting inflation with little investment risk. Of course, there are some drawbacks like the long maturity period and the fact that your money remains illiquid for so long. Still, understanding I-bonds' pros and cons can help you decide if purchasing I-bonds is the right money move for you. Enough from our side, everyone. We want to hear from you. What do you think of I-bonds? What do you think of these pros and cons we put out there? Are you considering maybe buying some I-bonds right now at this 9.6% level? This is pretty nuts. Please let us know in the comments below. This is Andy Hill from Marriage, Kids, and Money signing off. Carpe diem.